is here, and of course, I am joined by Mr. Lusambo, who is to be with me, first of all, live on air, live on social media. That's on the Money FM Facebook page. And yeah, we're going to discuss everything with regards to accounting. Good morning, sir.
Good morning. Thank you, Buchi. How are you?
Good morning. I'm fine. How's the day going?
It's fantastic. It's very okay. Yeah.
How's the whole isolation process going right now?
Yeah, I think it's been fine for me. I actually don't love to move a lot. I'm usually busy inside, so I don't see a difference anyway. Really, I don't see a difference.
Okay. So you've been working in isolation before COVID, eh?
For a very long time, yes, for a very long time. So I'm accustomed to being inside.
Interesting. All right. So today, what you're listening to is Accounting for Beginners, and today we're looking at a very interesting topic, and this one is referred to as reporting requirements for SMEs and small businesses. So, reporting requirements for SMEs and small businesses. What is this? What does this mean?
Well, as you know, Butch, there has been some talk, and also there has been some difference in terms of reporting for big companies and smaller companies. And the differences usually they
Indeed.
come about due to the huge amounts of money involved regarding compliance with full IFRS, that is the full international financial reporting standards. So to be able to accommodate smaller businesses, also to prepare their financial statements, but with a much less burden, the ISB has introduced the reporting requirements standards for SMEs, so that even them can have standardized financial statements.
Indeed, that's beautiful. Now, we'll get into what is the aim of accounting standards for SMEs. Really, why did they come up with this whole thing?
Well, as I have mentioned earlier, you know, the accounting standards for SMEs, this is simply a self-contained standard. The purpose is to help smaller businesses, as I've mentioned. That's the main essence why the IFRS came up with international financial reporting standards for SMEs. Because SMEs, as you know, they are smaller companies. They've not really grown to a level where they can have consolidated statements and the like. So to just be able to support them, because you know, nowadays, if you want to go and borrow money, you are an SME, you are a high risk in the eyes of the financial institutions, the lenders, because you don't have proper financial statements. So if your financial statements are prepared in accordance with IFRS for SMEs, you stand a higher chance of being given audience and in the end being given funds to run your business. So it's really a benefit for SMEs.
Anyway, who are the real users of SME accounts?
I didn't get that.
Who are the real users of SMEs accounts?
Yes, the real users are, of course, the shareholders, the owners of the business. If you are the shareholder, Bochi, you employ some people to work for you. And of course, those people are going to give you some accounts for you to look at. Now, imagine you've employed people, you don't see any statements. It's a bit difficult to see how your investments are being put to use. You may find it difficult to know whether your investments are being properly utilized or whether the risks are being taken too much, etc. So we've got the shareholders, the users, and also the management itself. Because sometimes as management, you want to come and refer to what you did the other time. You see, you want to come and see how you performed the previous year, but if you don't have record, how do you refer to what you did the previous year? But also even the government, for tax purposes, the government sometimes may request that they check the books of your accounts. So if they find that you don't do proper books, of course, we see those who don't want to register for tax. There are some penalties associated with that. So to avoid all those unnecessary stuff, it's pretty important that these statements are prepared. So those are the three users: shareholders, management, and possibly the government.
Before we even get into interim reporting and segment reporting, let's first define what IFRS is, or understand what IFRS is. What is it?
Yeah, for the layman, of course, I know you understand that one, but it's simply the International Financial Reporting Standard. It is a standard that is applicable. If you are an accountant, Buchi, you should not struggle to work in Malawi. You should not struggle to go and work in the UK, because as professional accountants, which we are taught, we learn these IFRS, the International Financial Reporting Standards, so that in case of a transfer, it is easier for us or for you to go and adapt in a different country, because you use the same reporting requirements. Yes. So that's the IFRS. So it's important for
All right,
companies
indeed. So
to follow these standards.
now that everyone is on the same page, why is earning per share, interim reporting, segment reporting, and insurance standards not covered by the by the IFRS for SMEs?
Yes, the reason is because usually the earnings per share is a standard that we usually calculate to give the potential investor, especially for somebody who wants to invest in a company. You may want to look at the earnings per share. Well, earnings per share, they give you the much more true value of the company compared to ratio analysis, where we do ratios. Because sometimes, if you do a good example, if you follow the profit that the company makes, it may be misleading. Just because you have a lot of profits does not mean you have cash, because the profit is simply a number on a piece of paper that can either be overstated or understated. But earnings per share is a much more detailed calculation to help you see the value. So for SMEs, we don't go to those lengths, because anyway, we don't even need potential investors in most cases, because they're not listed on LUCE. So we don't need those complicated standards for SMEs. And also, you talked of interim reporting. So interim reporting, interim reporting is according to, this is IFRS 34. Yeah, we are taught there in that standard that interim reporting is required only for those companies which are listed on LUCE. Now, the companies listed on LUCE are those like, we have Zambia Sugar, we have Zanaco PLC, we have those big companies. So they have to prepare those interim reporting. An interim report is simply a report which covers latest events. So if you're a company that has the year end of December 31st, and then you begin the year on January 1st, it means you have to prepare an interim report from 1st of January to June, and it must be made available to users within 60 days or less. So those ones are not needed for SMEs, because anyway, SMEs are not listed. These are individuals or partners and etc. who are in business. But just to help them improve on the quality of their statements, standards have been set for them to be able to apply. And if you look at the third one you mentioned, segment reporting, of course, this is also for big companies. Usually we discuss the under consolidation, so it's not required for SMEs. And insurance contracts, you see, you talked of insurance contract and insurance standards. These ones are complicated standards. The knowledge of these ones is not required by most users of financial statements, because they are really complicated standards. We don't need to overload too much data on an SME. The reason why we are the IFRS board has come with IFRS for SMEs is really to reduce the burden of compliance and the detail that come with full international financial reporting standards.
All right. The fact that the thing that has come up most of the times is standards. So now let's first of all define who an SME is and have a standard of who we're referring to. Who is an SME, or what is an SME business? Because we'll be referring to people thinking these are SMEs, but then it's a whole wide range.
Yes.
What's the range?
Well, there is no a specific definition for who an SME is, but it is difficult to define an SME because SMEs come in different sizes, different forms, and as you know, according to businesses, there's what you call industries. We have sectors, and we have all sorts of categories. So in each category, it is difficult to have a specific definition of who an SME is, because there are those who are in the sector, there are those in the industry, and also there are those in the market. So it's a bit difficult to have a specific definition. But however, each country has its own rules regarding who is an SME. Usually, SMEs are those companies um, uh, which are not really listed on LUCE. So, as I've mentioned, the standard itself tells us that there's no specific definition of an SME. But each country has rules, the criteria it follows to determine who is an SME and who is not.
All right, because I felt like we needed to know what makes businesses actually be referred to as and just have that form of understanding, so we're all on the same page. But moving on, what makes small businesses to shun the use of accounting standards? Why is it that small businesses do not have the necessary books? Why is it that most businesses do not want to use those books that come with that?
Yes, smaller businesses they shun the use of accounting standards, partly because of what you mentioned earlier. You see, for compliance purposes, for example, if you're a company butch and you want to be listed on LUCE, there are some requirements. For example, you must be in compliance with corporate governance, good corporate social responsibility, and all those stuff. So the costs associated with the compliance with corporate governance, corporate social responsibility, they are huge, and other listing requirements. For example, audited accounts and etc. All those costs, put them together, it becomes more expensive for smaller businesses. So in the end, smaller businesses, they usually say that the cost of complying seems to outweigh the benefit. It seems the benefit is outweighed by the cost. So in the end, they shun from complying. So to be able to assist them, this is why the IFRS decided to come up now with it, simplified standards, simplified reporting requirements for SMEs.
All right, if you're listening to this interview, this is Accounting for Beginners, and it's a chat between me and Mr. Lusambo. Check it out on our Facebook page right now. That's go to our Facebook page, Money FM Zambia, and you can also respond, ask your questions there, and you can get interactive with us on that particular platform. We're looking at reporting requirements for SMEs and small businesses, and that's the discussion that we have at hand at the moment. So you've talked about the huge requirements that come with these particular with having the right books sometimes for small businesses. But what are some of the simplifications that the International Financial Reporting Standards Board has done or has come up with to help small businesses in that regard?
Yes, there are quite a number of simplifications. Just to mention a few, for example, under full IFRS, when there's an associate or a joint venture, we use the equity model to value these ventures. But under IFRS for SMEs, we are told that the cost model is the only model permitted here, because we just want to get the value as a single line and boom, we fix it in our statements. We don't want to do a lot of complicated stuff like we do under group accounts, we do joint ventures, and we use the equity method, which can be a bit more involving for an SME. So to make it easier for them, the reporting requirements have been simplified. And the other simplification is that calculation is allowed if a measurement of defined benefit pension plan obligation involve undue cost. So even under pension benefits, there's a bit of simplification, because under IAS 19 pensions, it's quite a lot of things that we do to come up with to calculate the retirement benefits of an individual. But under this one, if the calculation involves undue cost or effort, there is a simplification that has been allowed for SMEs to follow. And lastly, we also have goodwill and other indefinite tangible assets. As you know, these ones are amortized over the useful life. But if useful life cannot be reliably estimated, we simply use 10 years. So that is also another simplification, because we don't want to waste a lot of time, so we just pick 10 years and we use it in our goodwill and intangible assets amortization. So it's such a beautiful simplifying things to also reduce the time for an SME that they can take time to calculate out all these complicated stuff that we do under full IFRS. So really, I feel
Oh yeah.
this is a step in the right direction. It's fantastic.
Indeed, and but these are some of the things that SME put into consideration, especially going into this particular year. Now, are there any reporting problems with such kind of with such kind of reporting? Do we see any reporting challenges with such kind of reporting?
Yes, yes, there is, Bush. Actually, there's a debate that is currently going on because you see, we have two companies that are reporting using two different standards. And really, as you know, we last year we did quite a run of auditing, auditing series and the other stuff. One thing that came out clear was that the reason why we have our financial statements audited is because we want them to hold what is called a true and fair view. What that means is that if I tell you today that I am 30 years old, that may be true, but is it fair for me to say that? It's not. What if tomorrow I'll be turning 31? So I've told you yesterday I'm 30, but maybe tomorrow I'll turn 31. So the information I've given you is not fair, even though it may be true today I'm 30. So you, when you get that information, you start telling others that this gentleman says is 30, when actually I've already turned 31. So to look at in the aspect of true and fair view, there has been an argument that how can accounts hold a true and fair view if they are being reported separately? So we are going to have two true and fair view. We are going to have two true and fair views, which makes it better, even a bit hot, because the same thing that you're supposed to do, you're not allowed to do it. Someone else is doing it. So it's like the simplifications are modifying the concept of true and fair view. It's like the other person is following everything the way it's supposed to be followed, and then the other person is being given a lot of exemptions. So which one are you going to follow as the real, true, and fair view of the accounts? So there's that that debate that has been going on.
All right. Thank you very much for that response. Enoch Lusanso saying you're enjoying the program. Thank you very much. And as well as Jason J. Siamutwa. They're saying you're enjoying the program. Thank you very much. Do stay tuned for some more. This is Accounting for Beginners with Mr. Lusambo, and we get to chat on looking at the requirements for SMEs and small businesses. So go over to Facebook, send the questions, let us know what your view is or what areas you need more clarification, and we'll be able to respond to those particular questions. Now, what are some of the many benefits of the IFRS for SMEs, or how can SMEs benefit from this?
Well, as you know, like we mentioned earlier, Buchi, there are lots of benefits. Let me just take you through them just one by one. Among the many benefits that we talked about is that the IFRS for SME is such a fantastic IFRS because they are very much user friendly. If you think about full IFRSs, even accountants, sometimes this is why we hold workshops for accountants, even those who are in employment, managers and directors, CEOs, we hold those workshops to be able to assist them and update them with the knowledge of international financial reporting standards, because they can be quite complex. They can be a bit complicated to understand, the English, the accounting jargons used. So all those jargons, the complications and etc. have been simplified under IFRS for SMEs into pure and plain English, to make everybody, even those who are laymen, to understand what they should be able to do. So that's quite a huge advantage. And also, apart from that one, Bushi, we have sometimes when you're a company, you're an SME, of course you have a vision where you want to be in the next 5 years. So if it turns out that you made quite some good fortune and then you want to transition into full IFRS, you want to be now reporting your accounts using the international financial reporting standards in full, not as an SME, but as a listed company, it becomes easier for you to do that transition because you're already accustomed to doing things in a certain way. It won't be so strange for you because you are used to doing this thing. So that's also another advantage. It is not that when there's simplification that the rules have been changed, no. They've just been simplified a little bit to make them a bit more flexible for people that are not really big companies to be able to have decent financial statements. And apart from that one, we look at the cost benefit side of it. You see, an IFRS for SME is a small standard. It's about 250 pages. So even the cost of compliance is very little, if not zero. There are minimal costs, unlike when you want to be a listed company. Because for you to become a listed company, especially on loose, there are lots of listing requirements, you know. There are lots of scrutiny. There are lots of things that are supposed to do, like we mentioned, the corporate governance, corporate social responsibility. Those are audit committees. There are lots of things involved, you know. Ethics are brought in, and for tax purposes, lots of scrutiny involved. So all those compliance requirements that are associated with listing are eliminated and reduced in IFRS for SMEs. This is what makes it easier, even for SMEs to be able to report easily. But even most importantly, like we mentioned, it is an advantage for SMEs because now they can have access to capital. SMEs are able to be given funding by financial institutions such as banks and other financial intermediaries because now they have decent financial statements which are able to show a beautiful and reliable track record. So I feel those are some of the beautiful points that SMEs are able to enjoy.
Indeed. So move on, we look at, of course, you've mentioned the other thing that you've kept mentioning is Luce. So now for everyone that's made, you may miss out on what Luce is. That's the Lusaka Stock Exchange. There's a lot of companies that are listed there regarding their shares and everything in that regard. Now, we've looked at the many benefits for SMEs in terms of getting onto the IFRS. What about we look at some specific areas? What are the many changes made by the IASB or the International Accounting Standard Board to help SMEs in relation to business combination?
Okay, and actually, I think even before we go to business combination, on the other many changes, just maybe to also catch up those who are in exam classes, because we've got people who are following us maybe who maybe also be in exam classes. On the main changes, let me just mention a few of the main changes. When it comes to financial statements, you see under full IFRS, if you are an accountant, you're a company, like your company, Bochivia, when you are preparing those financial statements under full IFRS, it is a requirement that a statement of changes in equity is included in your financial statements. Yeah. Well, for SMEs, it's not the case. So that's quite a beautiful simplification that has been given, because you find that all these statements which are maybe unnecessary for an SME, for an SME, they're not really done. But for companies, I think they are done. And also we can talk about you see, when you comply with corporate governance, it's the requirement that you also have committees like audit committees, remuneration committees, because the issue of stewardship is a big issue for big companies. The reason why big companies do social corporate governance is also to be able to protect the investments of the owners of the businesses. Now, under reporting requirements for SMEs, stewardship is not an issue. We don't really need all those corporate governance requirements and instructions. So all those are main of the benefits. But moving on to the question that you asked, if you may repeat it, I want to believe you said what are the main changes?
I was looking at business combinations and what are the many changes made by the IASB, the International Accounting Standards Board, to help SMEs in relation to just a business combination.
Okay, so under business combination, you see, when we are looking at business combination, a business combination is simply a company that buys another company. So, for example, the way you are at Money FM, you can acquire another smaller company. Maybe you can acquire another smaller radio station. It becomes a subsidiary to your company. Now, what happens sometimes is this: when you are buying a particular company, you are charged funds. Now, sometimes you don't have cash to pay. Sometimes you pay a contingent payment. Now, in the previous standards, the Goodwill IFRS number standard, a contingent payment used to be recognized after some time because it was based on a condition. But under the new IFRS revised one, we are told the contingent payment should be recognized immediately. Now, the beautiful thing is that under IFRS for SMEs, we don't need to worry about contingent payments and the like because transaction costs are now including the cost of the investment. So we simply get the huge figure, the actual figure. Okay, the cost of the investment is 20 million, and then we pick it. We don't have to start going around talking about contingent payment and contingent considerations. No. So it's such a beautiful simplification because also contingent considerations are included as part of the cost of investment. So it is very probable.
Hello, we're experiencing some intermittent network. I don't know if you can just check your connection or of some kind because it's breaking as you are speaking and causing a bit of a challenge. So I don't know if you can just check your connection there. All right, this is still accounting for beginners. We're looking at we're looking at reporting requirements for SMEs and small businesses, and we've looked at, first of all, accounting standards. We've also looked at some of the differences between interim reporting, segment reporting, and also insurance standards. After that, we also looked at why small businesses tend to shun the use of accounting standards. Now, we are looking at standard board and how this combination, and this is what you're sharing on. I think let's look at now in terms of expenses recognition. How does that work with the international accounting standard board?
Okay, so for expenses recognition, as you know, there's a standard that we call IS number 38. It's about intangible. There's a standard, as I was mentioning, it is called IS number 38.
Hello?
It's about intangible non-current assets. Now that standard gives guidance also on how research and development in particular should be treated. So if you think at if you look at the standard, it tells that whenever there's a research, those research expenses are sent to the income statement, and any development expenses that have been capitalized and approved by the government or the authorities must be capitalized immediately. Now, under IFRS for SMEs, all research and development costs and all borrowing costs are recognized as expenses. So we don't have to do 2 or 3 separate workings. All we have to say is we've incurred so much, and this is a total expense to the income statement. We forget. But if we go under for IFRS, we have to do calculations for the research, calculations for the development, and if we are borrowing costs, we do a separate working for borrowing costs, which may be a bit more involving as compared to IFRS for SMEs. So it's a fantastic move for the IFRS to be able to bring about these beautiful changes.
Also, I want you to respond to the same with reference to goodwill and non-current assets. In terms of the many changes that the IASB has made in terms of trying to help SMEs in relation to that.
Yes. As you know, goodwill in simple terms is simply the interest of owners in the business. The reason why companies buy other companies is because they want to have some goodwill. If I was to use, I don't want to use the word profit, but to just assist somebody who may not be having accounting knowledge, we may liken it to what we call profit. But for the purpose of the session, let's just say goodwill is the interest of owners in the business. And under full IFRS, goodwill and other intangible assets are subjected to an impairment review annually. So every year end, we do an annual review of impairment to see whether the goodwill has been impaired or whether the goodwill has not been impaired. And also there is an accounting policy that gives us a choice of how to value goodwill and intangible assets. Sometimes we can use the cost model, and sometimes we can value goodwill using the revaluation model. That is under the full IFRS. But under the IFRS for SME, it is only the cost model that we use. And the cost model is such a beautiful model because all we do, we simply ask ourselves, how much is this handy sanitizer worth on the market? Is 20 kwacha? 20 kwacha it is. We record. There's no need to subject it to other kind of. So it's very, very straightforward.
All right. The same breath as well. Maybe you can also look at investment property. How does that work?
Yes, investment property. Now you remember we had a discussion when we did the audit series. We talked quite a lot about investment properties, and we want to mention that investment property is a property that has been acquired for capital appreciation. If you buy a car so that you can be using it, it's not an investment property. It's simply a liability that you have. Under full IFRS, investment property offers a choice of either you can measure it using the fair value method, or you can use the cost model. So you have two options that you can value investment properties. But however, under this session, IFRS for SMEs, an investment property is carried at fair value. Have you seen? And also it can be measured without undue costs or effort. You see, when you are doing investment property under full IFRS, sometimes you do a sort of research. You go in the markets, you find out the market prices, which one are the most competing and prevailing market prices, and then you make an average price or whatever that may be. But under full IFRS, less effort, less cost. Such a beautiful simplification.
Indeed. How about the assets held for sale? How does that work with that?
Well, assets held for sale, these are assets that are dealt with under IFRS number 5. Now, the standard IFRS number 5 tells us this, that when you are a company, Buchi, and you have some assets that today in a board meeting as directors, you decide that you're going to sell, you must not report them as existing assets, because you're going to mislead the users of financial statements, because those assets in the next month or less or so, they're not going to be part of your company. So if somebody wants to invest in your company, they should be told clearly that these assets are reported here as held for sale, because anytime from now they're going to be sold. So we have to disclose in our statements. But under full IFRS here, assets held for sale are not even covered. Who cares? Nobody cares. So the decision to sell an asset is considered as an impairment indicator. So nobody cares about assets held for sale here, as we do under full IFRS, because full IFRS, it is also a requirement if you want to also list on LUCE, that you disclose sufficiently everything that needs to be disclosed to the public, so that they know where they are going to put their investments. So under IFRS for SMEs, man.
All right. Now, lastly, just look at lastly on the many changes that the International Accounting Standards Board has made to help SMEs. But there's these two things: employee benefits and income taxes. How is that working?
Well, the issue of accrued benefit valuation method, the projected unit method, is required for calculating the employee benefit. So when we are using under full IFRS, we usually use the projected unit credit method. I think that one is a bit more detailed standard. We can have a session for another day on how to talk about employee benefits, because we have lots of people in employment which who don't even know how much they will get when they retire. And that is so sad, because people need to plan for the future.
Indeed.
If not now, at least. So it's important that we discuss this standard also. So here we use a method called the projected unit method. is required. But under IFRS for SMEs, really it is simply a circumstances-driven approach that is acceptable. What are your circumstances? So that's the approach used. So there's nothing much really. Here on the employee benefits, I've tried as much as possible to keep it simple. I must mention that there is a lot of technical terms and lots of things to talk about, which we cannot be able to comprehend in this session. But
I think we will create time to actually talk about that separately. Maybe let's focus on the income taxes.
Yes, the income taxes. Now, you remember what we mentioned earlier, that income taxes, especially for listed companies, it is a requirement that you fully comply with the tax rules. For example, nowadays, for us, for companies, if you're in business, I've seen you won't be able to get a contract if you don't have what we call a tax clearance certificate, because you're not compliant with the rules. So nobody will trust that kind of business. Everybody wants to do business with a company that complies with tax rules, and that's fantastic. Now looking at the full IFRS, in terms of deferred tax, no deferred tax is recognized upon the initial recognition of an asset. So we wait up until such a time when the deferred tax has been due. But under the full the IFRS for SMEs, we don't have to worry about that. Management recognizes the effect of the possible outcome of a review by the tax authority. So they're going to say, okay, maybe in the next 2 months or 3 months, ZRA or the tax authority are going to give us a relief of so much. So they have to recognize that one in full. But under full IFRS, management does not recognize that deferred tax immediately. They've got to wait at least up to some certain assurance has been given. But however, I must mention that there's a standard IS number 12. It's quite a huge standard that talks about deferred tax and other tax implications. So I think that also would be a beautiful standard to talk about, because we see many businesses nowadays now set up. They have tax issues. I went to pay tax for my company one time, and in the office there was a man who said that he had the proper tax clearance certificate for some time, but this time around he paid an agent who ran out with his funds. It didn't even do the job. So people are scared of going to ZRA. They feel it's difficult when the process is just so simple and straightforward. So they end up spending more money on the agents, extremely huge amounts, so not even relevant for tax purposes. So I think it could be a beautiful standard to discuss also at a separate time.
Yeah. Now, as we come to the close of this discussion, should small businesses comply with the International Financial Reporting Standard?
Looking at what we've discussed, Buchi, what do you think?
It looks like it's something to put into consideration for small businesses, and to start working towards getting the right books and putting yourself in the right place. Because especially if you have the intention of growing your business to a place where you can actually put it on the Lusaka Stock Exchange and have it have an opportunity to actually market your emerging corporates and just grow your business entirely. That's just my view. But let's hear from you, the expert.
I think you've nailed it, Butch. That's beautiful. It's fantastic. Like you've mentioned, if you want to grow a business, because sometimes we all need help. At some point you're going to chance a huge contract that is beyond your financial muscle. So if you don't have proper, decent financial statements, it's going to be difficult for you to source funding. You end up going to get Karoba, which will be about 50% more than the man is supposed to pay if you went to the bank. So being able to comply with IFRS for SMEs comes with its own advantages, especially in terms of access to capital and also access to wider markets. You see, there are certain markets that you can't be allowed to trade on because you're not listed, because you're not in compliance with the other listing requirements on that particular market. So having these IFRS for SMEs can also boost confidence in potential investors in the truthfulness and the fairness of your financial statements. And also think about it, Butch, if you're a company and you're a partnership, it improves confidence between partners because it acts as a means of settling accounts. Because now you know exactly what both of you have and how things are moving in your company as partners. So it's such a beautiful move by IFRS. However, we must mention that the reporting requirements for SMEs vary from country to country, depending on on the criteria for each region, country, or location. Take, for instance, what may seem to be an SME in the UK may not be an SME in Zambia. You see, because of the capital requirements that the authorities may want. For example, in the UK, £20,000 is a small amount of money. Come to Zambia, the same money is a huge amount of money. So each country has their own requirements for who is an SME and who is not. This is why we say the standard tells us there is no specific definition for who an SME is. It depends on the criteria set by the authorities.
Yeah, beautiful stuff. And yeah, it was an interesting talk. I think it had to happen the way it has happened. I like that you made reference to the exchange rate, which was one of our talks. I think some time back we did make reference to the exchange rate and how it affects the books of accounts and how just especially debt servicing and everything in that regard happens. But yeah, thank you very much for coming through. As always, every Tuesday you can catch it on Money Listening Radio, and you just tuned. Still catch the full interview on our Facebook page. That's at Money FM Zambia. You can see where it all started, where we built from to where we are actually ending. So for those that have been listening online, Enoch Lusanso, thank you very much for staying tuned, and as well as Jason J. Siamutwa, thank you very much for staying and stay tuned. Business Talk radio station. Do stay tuned. This has been Lusambo and myself on Accounting for Beginners. Keep it locked.
Thank you so much. Have a good day.